Hello everyone, welcome to our discussion of chapter 15. This is the last chapter we're going to cover in the textbook, and it has to do with C corporations. We talked about partnerships in chapter 14, and we're going to talk about C corporations in this podcast, and then S corporation, which are also in chapter 15 in our second part of the podcast explanation. So, corporations, both C and S, are legal entities separate, formed under the laws of the state. So they are separate entities from their owners. That has implications for how liability works, for investment, for management, all of those things. But we're focused on what does it mean for tax purposes. So to start with, if you become a corporation without doing anything special, without doing any extra paperwork, you become by default a C corporation. That is the default when you organize a corporation and submit your paperwork to the IRS. Okay, these C corporations have to use the accrual method of counting, but not until they get over $25 million of sales. So most small corporations, C corporations, can operate like we're kind of used to on a cash basis, meaning when the money comes in, they have a tax liability, and when it goes out, they have a tax deduction. They can choose any fiscal year because they don't interact with they're really separate. They pay their taxes themselves as C corporation. What tax year they use doesn't matter. As long as they do have to choose the end of a year. End of a month, I should say. They can't choose July 15th. If they want a fiscal year, it has to be July 31st. Or it has to be the same day of the month each year. So, for instance, it will work to be the fourth Tuesday of November each year. Can't imagine why they would choose that, but that's allowed. Some retail companies like to do match up the weeks year to year, but you can choose whatever because you're going to pay the taxes. There's no interaction between the forms that the corporation files and the shareholders, except for, as we'll see later, when it comes to dividends and things like that. And that can be in separate years, so it doesn't matter. The form that they file is 1120. If looking at the 1120, in your textbook, it looks very much like, the first page looks very much like an income statement, revenue at the top, and then expenses, and then as you go on, it basically deals with the special items that apply only to corporations. So you start off by calculating basically your taxable income using an income statement format. They're due the 15th day of the fourth month, April 15th for a calendar year, but can have 6-month extensions. Okay, there's a weird rule about this. If you use a June 30th year, okay, you have only till the third month, but then you get a 7-month extension to kind of make up for it. All right. So, first thing we need to talk about is forming a corporation, becoming a corporation. This could be an existing business. This could be it's already operating as a partnership or a sole proprietorship and wants to come as a corporation, or it could be from scratch, meaning it doesn't exist and this is going to be a corporation from the get-go. All right. So what we're looking at is the situation where we're transferring money to the corporation or assets, and the corporation is giving that investor, that shareholder, shares of stock. They become then a shareholder. We generally do not want to recognize gain on this transfer. Okay? So the general rule is we probably don't want there to be gain, but that flies in the face of the general rule that when you exchange something, add a gain, meaning you get something more valuable than what you have in the basis of your property, that there is a gain. And so there are specific rules. Now with partnerships, there's no specific rules about having gain on the transfer of your into the partnership. But in a C corporation, and this applies to all corporations, those who transfer the assets and the cash into the corporation must have 80% or more of the corporation after the transfer. Otherwise, you could have gain. All right? So if you want to make sure that there is no gain, there needs to be a transfer all of a group of, it can be multiple people, multiple shareholders, but when they transfer, they together at the same time have to own 80% afterwards. Now, there's situations where even that won't work, and that is if the shareholder contributes assets that have a liability. So I own a building, and I have a mortgage on that building, and I contribute or invest that building. I put it into the corporation. The corporation gives me stock. But the corporation assumes my mortgage, my liability, okay? If my liability that they assumed is higher than my basis, then I have gain. If I receive anything other than just stock, meaning any other type of property, other than stock in the corporation. So I put in an asset into the corporation, and the corporation gives me that corporation's stock. That is not boot. But if they give me some stock and some cash, or stock and an automobile, or stock and a piece of and a painting, whatever it is, that's not stock, that could have gain, okay, and up to the amount of that boot, that other property I receive. So what happens if I have a building and I contribute it and that I don't have any gain because all I get is stock in return, then my basis in the building becomes my basis in the stock. So my basis, because I have to know what my basis is in that stock for when I turn around and sell it as a shareholder. The corporation needs to know the basis of the building that I just contributed so that they can do depreciation calculations. All right, so assuming there's no gain, then my basis in my building becomes the corporation now has that same basis. So if my basis is $80,000, even if the building's worth $200,000, when I contribute it to the corporation in return for stock, then the corporation's basis in that building is $80,000, and my basis in my stock is $80,000. If there's a gain recognized, I'm going to add that. So if there's an assumption of a debt or some boot property that I receive that triggers gain, then I add that to my basis as a shareholder. And this is what it talks about. This other slide was about the inside basis, what the basis is to the corporation, and on the outside basis, my basis in my stock, if I don't receive anything, is just the basis in the assets I contributed. But if I receive boot, I gotta add the gain and then subtract any boot, because it makes sense. If I give a property that has basis of $80,000 in return for stock and some cash, that I should not get basis in that stock of the full $80,000. I should have to subtract out what cash the corporation gave me on top of the stock. Okay? And so that basis for a C corporation is going to stay. So when I contribute my building and it's got a basis of $80,000, whatever the value is really irrelevant, okay, as long as it's higher than that $80,000. Then my $80,000 in that stock really becomes my basis until I sell it. Okay, unless there's some dividends, special dividends. But otherwise, I don't really worry about that basis until it comes time to sell that stock 10 years down the road, 5 years down the road, whatever. And then that becomes how I calculate the gain on the sale of that stock to another party. So an example, Arturo contributed land with a fair value of $100,000, basis of $40,000 to a newly formed corporation in exchange for 90%. So Arturo controls 80% or more, right? So his basis in the stock is the basis. Okay, he didn't receive anything other than the stock, and it's the same as his basis in the land, $40,000. And again, that's going to be his basis until he sells that stock. There is not a constant change in that basis like there is with a partnership we learned about in chapter 14. So generally the rules we learned about, what is deductible, what's not deductible, depreciation, all those good things that we learned about individuals, we try to use this as much time as we can. We use the same rules, okay? Except that we're not calculating AGI. There's no intermediate AGI calculation, although, as we'll see, there are some intermediate calculations on our way to taxable income for a corporation. First of all, what we were looking at really are the differences between a corporation and what we've already learned about individuals and calculating their tax liability. Roughly the same tax formula applies except for these differences. Okay? Capital gains and losses are netted together, but there's no capital losses are not permitted. So remember, individuals can have a capital loss up to $3,000 to offset against other income. That is not the case for corporations. They can only deduct capital losses against capital gains. So if they have a year that they have just a capital loss and no capital gains, then there's no benefit to them tax-wise. All right, it can be carried back 3 years and can carry forward 5 years, okay? But it still only offsets capital gains. It doesn't offset regular corporate income, but other capital gains. So if there were capital gains 2 years ago, you could carry back your capital loss from today, from this year, back 2 years and offset that. But if there weren't any, it's still not going to do you any good. And capital gains are taxed at regular income. There is no special tax rate like we learned about for individuals for corporations. The moral of the story is corporations, they're not a good place to have investments. You can't take advantage of losses, and your gains are taxes regular income. So it's not a very advantageous place to have investments like stocks and bonds inside a corporation. All right. Charitable contributions. Remember, there were percentages of AGI limits on charitable contributions for individuals. There's also a limit in charitable contributions for corporations. It's much lower, okay? It's 10% before you consider the charitable contributions. The dividends received that deduction we're going to learn about shortly, and carrybacks, any carry forwards or carrybacks that you might have. Okay, so for 2020 and 2021, that's 25%, and it'll go back to 10% unless the laws changed again in 2022. Excess is carried forward for 5 years. That's the same as we dealt with individuals. Okay. Just as an aside, one of the things that often gets contributed by a corporation as a business is its inventory, right? Maybe as a donation to an event or something. It could be food, it could be T-shirts they make, whatever. That is limited to the cost, what it costs us to make that, not the value that if we would have sold it. So a corporation donates a T-shirt that costs them $4. They don't get a contribution for $10, which is what they would have sold that T-shirt for, but rather just the $4 that it actually cost them. So the charitable contributions has a similar feel to individuals, but the different limits. This dividends received deduction is very different. This has nothing to parallel individual taxation. So what this is dividends for a C corporation are not deductible. So a corporation that pays dividends does not get a tax deduction. So they pay taxes on that income. They give it to their shareholders who have income on their 1040 or whatever, okay? And so they pay tax on it, depending on if it's a qualified dividend and the rules having to do with that. It could be reduced rate, but it's still taxable. That's what is referred to as double taxation. If a corporation owns stock in another corporation, receives dividends, and then turns around and pays its shareholders dividends, then in theory it could be triple taxed. So the dividends received deduction is to prevent triple taxation. So if a C corporation, and it only applies to C corporations, owns stock in another corporation, then it receives a deduction for 50% of the dividends as long as their ownership is less than 20%, 65% if it's 20 to 80%, and 100% if it's over 80%. So this is how you calculate the dividend received deductions. First of all, you put the dividends in the income with all the rest of the income that you receive from the other corporation. Then, again, on a separate page on your the 1120, you calculate, based on the ownership you have in those corporations, what percentage of the deduction you get. So you add in, let's say you own less than 20%, you add in all the dividends as income, as revenue, and then as a dividend received deduction later, okay, as you calculate taxable income, you deduct 50% of those dividends. So the end result is that you're going to have taxable income of half of your dividends. Okay? This can be limited. The dividend received deduction can be limited when your dividends are a significant part of your total income, such that you can't basically have a deduction that's greater than your income, greater than a percentage of your income. However, if it creates a loss, it will still apply. So there's some calculations in your text about how that limitation plays out. Most of the time it doesn't apply, but it can in certain circumstances if your income hits a certain level, usually on the low side. Another issue with corporations, they may spend a lot of legal expenses and other types of things before they actually get started. They can recognize those as an expense, okay, up to a point. All right, the rest of them must be deducted over 180 months. Okay, that's 15 years, by the way. Amortize and deduct over 180 months. Up to 50,000 can be immediately deductible. All income, all taxable income, when you get to it, is taxed at a flat 21% rate. So this is really easy to calculate the tax liability on a corporation. Under current law, you just calculate the taxable income multiplied by 21%. Okay? Now, we're not going to wait till April 15th to get all the money for the corporation owes. Okay? So they must make estimated payments or get charged penalties and interest. Okay? They owe 100% of the tax due for the year. They make it on the 4th, 6th, 9th, and 12th month of the fiscal year, however that falls. So they need to make estimated payments. They can't just wait till they file their tax return to pay it all in, or they will be subject to interest and penalties. They can either pay 100% of last year's or what it's going to be for the current year. And again, if you don't make high enough payments, you could be penalties and interest. Net operating losses, okay. Their old law has been changed a couple of times during the pandemic. Okay, first of all, we got rid of NOLs. So first of all, before 2017, if you had a loss in one year, you could carry it back to the other years and forward. Okay. NOLs generated in 2018 can be carried back 5 years. They pulled that out during the pandemic to help companies. Carry forward is limited to 100% of the income in 2020 and 80% in 2021, and can carry forward indefinitely. Again, that's scheduled to go out of, to become not the law again, okay, this coming year. So a corporation reported taxable, an example of $390,000 before charitable contributions. So without considering, they made $100,000, okay? But you can't deduct it just automatically. You have to calculate to see if we're over the limit. And so the limit for 2021 is 25% of the income before considering the charitable contributions. And that would be, in this case, $97,500. So you would have a limit of $97,500, with the other $2,500 being carried forward to next year. So corporations have a concept that is very much like what we learned in earlier accounting classes, retained earnings. Basically all the profits they've made. But it's calculating using tax rules, not regular U.S. GAAP rules, okay? And when a corporation distributes the money out of this pile of what they've earned over the years, that's dividends. And as long as it comes out of that pile, it is taxable to shareholders and not deductible to the corporation. All right? Now, what if a corporation gives to shareholders more than what is in this pile? More money than what is earnings and profits. So then is non-taxable to that shareholder up to the amount of their basis. Remember, we talked about basis when I contributed my building to the corporation. Now that comes into play again. Okay? So if I got a dividend up to the amount of the earnings and profits, is taxable to me as a shareholder. If I get more than that, the next part of it is not taxable as long as I have basis. So that is going to change my basis because it's going to reduce it. So if I get a dividend in excess of earnings and profits, that's going to come basically a repayment of what I put into the corporation. Once I have all that money back that I put into the corporation, okay, now it is a capital gain. So we're talking about a situation where the corporation distributes a lot more than what is in the earnings and profits. You have to worry about how that is treated. First part, dividend income to the shareholder. Second part, return of their basis. Third part, capital gain. Okay? If the corporation distributes property, meaning an asset that especially has value more than what its basis is, we first treat it as if the corporation had sold it at a gain. So the corporation has a gain, reports it as part of their income, all that stuff. We truly treat it just exactly like if it had been sold. And then the distribution is the value, the fair value of that asset to the shareholder. And you have to look at that fair value of the asset you're receiving as the dividend amount. And you have to go back and apply the same idea. Is it an amount out of earnings and profits? Is it an amount that goes beyond earnings and profits and return of basis? Is it an amount that actually constitute capital gain? When the company is completely going out of business, okay, we record all the assets and liabilities at fair market value. Usually those are going to be a loss, so we record that loss, okay? And then the shareholder reports capital gain equal to the fair market value of the distribution. So we sell everything, distribute the cash, the shareholder is going to receive cash, compare it to their basis, and that's going to give us gain or loss. Okay, an example, corporation net earnings and profits is $10,000, makes a cash distribution to its sole shareholder amount of $11,000. So there's only one shareholder. The dividend is taxable to $10,000, right? Up to the amount of the earnings and profits in the corporation. The other $1,000 that they distributed would be a return of that shareholder's basis. All right, a little bit more about the forms that are filed. Schedule L, M1, M2. Okay, small corporations don't have to do this, but basically it's a reconciliation as to what you're reporting on taxable income to what you reported on your regular income statement to the rest of the world. Okay, and that's what you show how your balance sheet looks, all of your financial information, and how it compares to what you're reporting to everybody else. In these sections, M1 is reconciliation, all the differences between what you deducted for tax purposes versus what you took as expenses on the income statement. Okay, just some quick ones. The meal expenses are reduced, then you get the full 100% on the income statement, only 50% on the tax return. That's a difference. That's been changed for 2021. If there are restaurant meals, there's not a difference. Charitable contributions can be different because all charitable contributions are deductible for income statement purposes, but we know there's a limit for tax purposes. So there could be a difference. Some other things that happen is if corporations are owned by the same people, they can file a consolidated return. All right. Save a lot of paperwork. And if they are owned by the same people, okay, there is like parent, brother, sister groups can also file consolidated and disclose it. And there's this interest expense limitation that they put into the tax law in 2018, which basically says you can't have a deduction for interest too high. Basically putting a penalty for borrowing too much money, with the idea that the concept was corporations would borrow a whole lot of money, have a whole bunch of expenses, interest expense so that they didn't have to pay any taxes. Okay, and so this says you can't have that more than 30% of your adjusted taxable income, but you get to carry it forward. And again, we made an exception for anybody less than $26 million or less. So, but most corporations are not going to be affected by this. This is only for larger corporations.